or the stock is in la la land on multiple
is no one can make sense of the multiple.
Nosebleed territory.
They're all wrong about Palantir, and I'm about to prove it. I've been investing in early stage tech for over a decade, and I've made millions spotting trends before they hit CNBC. And what I'm seeing with Palantir right now feels a lot like the early days of Tesla or Nvidia. In this video, I'll show you the real way to value Palantir, the one that actually explains why it's still grossly undervalued, even after its 2025 run-up. And at the end, I'll reveal my long-term price target, and it might seriously shock you. But first, we need to go over why Palantir is so different. Most software companies focus on convenience. Palantir is focused on power. They're not building tools, they're embedding decision-making logic into government agencies, global logistics networks, and Fortune 500 workflows. We're talking about AI agents underwriting insurance better than humans at AIG, Walgreens using Palantir to automate 384 billion decisions across 4,000 stores, the US military building operational platforms directly on top of Palantir software. This is an SAS. This is infrastructure, and just like how AWS quietly became the foundation of the cloud economy, Palantir is becoming the AI infrastructure layer of real-world institutions. Check out what CEO Alex Karp just said.
The mission of Palantir is to give an unfair advantage to our friends. And if you look at what regional banks have been saddled with regulatory hurdles and deep technical issues, almost all of which can be solved by the combination of his insights into banking, which he's one of the most successful people in the world at, our tech infrastructure and large language models and compute. And that combination will bring the unit economics of a company like Palantir to regional banks and allow them to do what big banks are claiming to do, and grow their revenue at much lower cost.
Palantir's Q1 numbers showed 124% net dollar retention. That means, on average, each customer is spending 24% more each year without the company even needing to find new clients. That's called a flywheel. And in business, flywheels are everything. Amazon's flywheel worked like this: more products, more customers, more sellers, better prices, more products. It fed itself. Tesla's flywheel: more data from cars, better autonomous models, safer driving, more adoption, more data. Palantir's flywheel is all about deepening integrations. A customer starts with a pilot, then rolls out a multi-million-dollar deployment, then scales across the entire organization, all while continuing to spend more every year without any sales effort. That's how you build exponential free cash flow without needing exponential headcount. That's how platforms get built. If you're looking at Palantir and thinking 500 times forward earnings, no thanks. You're not wrong. But you're using the wrong lens, because the exact same thing was said about Amazon. When it traded at 900x earnings, Nvidia when it looked topped out at $42, Tesla when it had a triple-digit PE and no GAAP profits. And Dan Ives feels the same way.
But look, I mean, the value, if you go back the last few years, right? I mean, they hated it at 10, despised it at 100, and that would be the continued argument on valuation. If you look what's happened to AI revolution, $2 trillion of spend over the next 3 years on the software side. It's their world. Everyone else paying rent, and it comes Palantir. So my view is, if you look at it just on valuation, and if you went back, you've missed every transformational tech stock the last 20 years. If you just focus on valuation, where is this in the next 2, 3, 4, 5 years? And I view what Karp's doing to Palantir is generational. But again, the haters are going to hate. I get it. Valuation, check the box. You look at these numbers. To me, I think this is just another sort of table pounder moment, for what I view as the Messi of AI, Palantir.
Disruption doesn't show up neatly inside a price-to-earnings ratio, especially when the product becomes irreplaceable. That's why we use the EVR model instead, embedded value plus runway. EVR looks at two things: what the company is already doing, with current free cash flow and customer retention, how much market it still has left to capture, with platform stickiness, contract expansion, and TAM penetration. Think of it like this: PE looks at today, EVR looks at today plus tomorrow on a compounding curve. And for a company like Palantir, that's the only model that actually makes sense. Let's start with what Palantir is already doing. In 2025, they're projecting $1.7 billion in free cash flow with 40% plus margins. and a 27.5% annual growth rate. If you compound that out for 6 to 7 years and discount it back at 10%, you get a discounted free cash value of $5 billion per year. Now, apply a platform multiple of 50x. That may sound high until you remember AWS trades at 40x, Datadog, Snowflake, CrowdStrike all trade at 30 to 50x. When you're the foundation of a new computing paradigm, the market pays up. This gives us an embedded valuation of $239 billion. And we haven't even touched the additional valuation from the runway yet, just from what Palantir's already doing with its current customer base. And according to expert investors, the AI boom is just getting started, which means growth will continue to accelerate.
We're just getting started. We're in the first inning. This is 2000 to 2003 internet time here. And what we heard over the last few weeks is all of the biggest companies in America continue to double down on their investments in AI, and they're seeing the paybacks.
The hyperscalers are not slowing down. We're hearing consistent commentary. Amazon talking about as soon as they put infrastructure in the ground, it's already at capacity.
So currently, Palantir's total addressable market for institutional AI decision systems is projected at $600 billion. Plus, if they capture just 5 to 7% of that, maintain 40% FCF margins, and apply a conservative infrastructure grade multiple, we're talking up to $588 billion in potential future value, and that's before considering 2.5 to 4x contract expansion from early customers, a 124% net dollar retention compounding every year, mission critical deployments in sectors where churn is basically zero. So yes, the runway is massive, but it's not even the final price prediction yet. We still need to combine it with embedded value, which I'll do at the very end. But first, let's zoom out. When a company becomes so deeply entrenched that pulling it out would cost more than keeping it in, that's when valuation stops being about earnings and starts being about dependence. Examples: AWS can't be ripped out once your entire company's backend runs on it, TSMC. No chipmaker can switch fabs without years of delay, Microsoft Office. Good luck getting your team off Excel, Salesforce. Once workflows are built, no one wants to retrain an entire organization. Palantir is on that same path. Just look at how crucial it's becoming.
I spoke to Karp and he said it to me like this. He said, quote, say you're a PE company, you acquire a large insurance company and you wanted to change the cost of revenue, meaning how can you have fewer people doing the same amount of underwriting and have the same number of customers? That was a multi-year project, like 3 to 5. Now it's a one-quarter cost that's completely different. And if you do it and the company down the street doesn't, you're going to have very different margins and very different revenue.
Because once you build a company's AI decision layer, you don't just swap it out. You build everything on top of it. And that makes switching costs functionally infinite. So now let's combine both sides. Embedded value, $239 billion. Runway value, $588 billion. Add those up, and we get a total EVR-based valuation of $827 billion. And with 2.55 billion shares outstanding, that gives us a long-term share price target of $365 per share. At the time of recording this, Palantir is trading around $115, so yes, the stock has had a massive run in the past year. But honestly, it hasn't really even started, because Palantir isn't just a software company. It's becoming the default AI operating system for defense, finance, healthcare, and government. And once the market catches on to that, the re-rating will be violent. If you made it this far, comment Palantir OS, so I know you're one of the few who actually sees what this company's becoming.